Hello everyone, welcome back. So today I decided to start another series for Wall Street Raider. I decided to start one called Industry Roulette. Basically what it is you start off with $1 billion, and I'm doing difficulty of 1 just to make the game a little bit more easy, because it depends. I could get a bunch of garbage industries, or I could get something like banking and insurance and make billions of dollars in this game. So I feel like it'd be fun to try out different strategies with different other companies. So today we're going to be playing around with that today. And I have some things that are very, very important that we have to cover first before we get started with this challenge. Okay, so now we go into one of the first definitions that I love. It's called the working capital ratio. So when it comes to this game, a lot of the times in this game, a lot of businesses go bankrupt because of working capital issues. So I'm gonna go ahead and zoom it in, make it a lot better for you guys to see. So we can see right here that working capital basically is the difference between a company's current assets and such as cash, accounts receivable, customer unpaid bills, inventories, raw materials, unfinished goods, and its current liabilities, such as accounts payable, like that'll be debt and stuff. Basically, current assets are anything that you can turn into cash within 1 year. So typically cash is good, inventories are good, but if you're being a little bit more picky, you can do something called the quick ratio. And that's basically excludes inventory, because inventory is generally a very, very hard asset to sell in general. And so I feel like that is a very, very important thing. And I have plans on doing a bunch of financial based ratios in order to make sure my company operates fine. And so like that's a bit, working capital is probably one of the most important. And if a company has trouble with its current ratio, it potentially could go bankrupt. And if we have good operational efficiency, like we have a lot of liquidity, aka cash in the bank, we're able to basically weather off storms in the market, in which there are going to be storms. The market goes up and down because of credit. So you think about it, a lot of the time some businesses do really bad because they borrow a lot of money, and then their projects don't turn out to be as well as they expected, and then they end up losing a lot of money on their projects and everything. So honestly, I'm going to try to avoid debt like the plague, or unless it's a very, very strategic debt thing. And so I feel like a very, very important thing also to note would be optimal capital structure. So if I'm in a very, very high risk business industry, I generally want to take on less leverage. But if I'm in a safe industry like utilities, basically then I would like to take on more debt, because it's a bit of a safer industry. But the more riskier the industry, generally the less debt I'm going to be taking on in this series, because I don't want to risk bankruptcy. And plus, I'm only doing one industry, and we're also going to be doing the roulette wheel. So the roulette wheel is basically going to be, it's going to pick me a random company out of the blue, and I'm going to have to operate that company. So I feel like it might be interesting to play around with. So I'll make sure to link this in the description, basically. And the working capital ratio is basically the current assets divided by the current liabilities. It's a very, very important ratio. We also got current assets, what they are. So current assets are basically, current assets appear on the balance sheet and one of the financial statements. It's one of the safest generally, because your property, plant, and equipment is like long term. And generally if you buy a piece of equipment and if you're in financial desperation, you might have to sell your equipment for less. So hence why I'm going to be trying to keep a good current ratio in this game, because I don't want to sell my assets for less than I'm buying. But we're still going to be investing in property, plant, and equipment in this game. And then we have cyclical versus non-cyclical stocks. This is one of my most favorite examples, because basically in real life we have something called cyclical stocks and non-cyclical. Your non-cyclical stocks are basically your defensive stocks that can weather a storm pretty well, but they're still going to do pretty bad financially, because everyone gets hurt during a recession. Everyone. But the good thing about a non-cyclical stock is generally they're going to do better than the cyclical stocks. So, not really financial advice in any way, but if you think that there's going to be a correction in the market, it might be a good idea to go ahead and buy up some utility companies or companies that are defensive, like grocery stores or low risk businesses that basically people need. And if you're a little bit aggressive, like I'm playing a bit of both sides when it comes to my personal portfolio. I have some uploads where I talk about the cyclical companies that I'm buying. Like, for example, I have a hotel, and I'm betting that the travel industry is going to have a bit of a recovery because of the coronavirus. Because we have vaccines and everything, but the Delta variant has me a little bit afraid. So I'm trying to get a bit of return from both ends, where I have cyclical stocks to get me extra return if the economy does well, and I have defensive stocks if the economy does bad. And the best defensive stock, in my opinion, isn't actually a stock. It's a different type of asset allocation. You can have bonds or you can have cash. So if you're betting that there's going to be a bit of depression happening because of the whole coronavirus, like you think the coronavirus, we're going to enter into another lockdown, etc., it might be a good idea to start stocking up with some cash and then waiting for good deals in the market to come up. Because stocks, they always get hurt during depressions and recessions. So a good range of cash, in my personal opinion, is 5 to 10% at least. So for example, if you have basically a portfolio, if you have a portfolio of $1,000, you want to keep 0.10, which is 10% of, so it'll be $100 you're gonna keep in cash. And that $100 is meant for liquidity needs. So if you have like an emergency bill come up, you're able to cover some of those expenses. Or you're able to go out there and buy some stocks whenever there is a sale in the market. And there are often sales in the market. Like the market a while ago just dipped like 2-3%. So there's some good deals that pop up in the market every now and then. So keeping some cash is a very important thing. And so that's why in this game I like to keep a very liquid position when it comes to Speculator and Wall Street Raider. Okay, so we're back. So what we're going to do is we're going to look at cyclical stocks just a little bit more. So they usually do bad in the economy. And a good example of a non-cyclical stock, in my personal opinion, would be Dollarama. But some of their inventory is cyclical in nature, but most of it is very defensive in nature. Because you think about it, Dollarama, they sell very cheap goods. So if I theoretically were to do the strat roulette, we could do general right here, and then we could pop up per industry growth rates. And then you can see right here, retail. So we're doing retail. And then it would be considered a discounter. So discounters are basically companies that offer products for a discount. So dollar stores will fall under there. Walmart will fall under there. So they tend to be a very recession-proof industry, or somewhat recession-proof. Like I said, there's no golden answer to solving the whole problem. The best answer is probably cash if you think a recession's coming. So I find that pretty interesting. So like that's a bit of a what Dollarama is kind of like. And then we can actually look into the actual financials of a company. So in order to do this, you have to go and type it out on Google, Dollarama IR. The IR stands for Investor Relations. And Investor Relations is basically the shareholder information that you can receive, because this is a publicly based company. They have to upload data to us because we own part of the company, so we have to understand what they do, etc. So like here's the Dollarama homepage for Investor Relations. And then I actually looked at their most recent quarterly report, which is right here on their financial statements. And then they have their earnings. So the earnings I like to see as a potential way of saying, hey, we got your income. So your income from your job is potentially a earnings thing. So like that's a great way of looking at it. And then the balance sheet is just how much cash you have, how much assets you have, and how much debt you have. So it's a great view of how healthy your company is. So for example, I actually clicked on this, the financial release, and now we can actually look into the balance sheet of Dollarama and look how much money they have in basically things. So you can see that right here. We can go up down here. This was uploaded on May 2nd, 2021. So it's semi-recent, and I'm hoping that their second quarter does well. But we're looking at the financial health of the company. So right here, like I said earlier, this is a real-life example of an actual stock, Dollarama. It's DOL. And you can see their current assets, which is basically right here. Cash, they have $49,000, which is expressed in thousands of dollars. So this would be 100 times 1,000. They basically have $49 million in cash, I believe. And their inventory is actually pretty high. So their inventory is very, very high, but they have 49,000 in cash, which I like. And if we look over here at their non-current assets, like these are basically your long-term assets, like I said. These are property, plant, equipment. So this is where you make most of your returns. But the problem is, you might not be using your assets correctly. For example, property, plant, equipment. Let's just say you were buy a property, plant, equipment and it gives you an 8% return. That's pretty great. But sometimes you can make 20% in this game, or sometimes you can make negative percents because you're not using your equipment correctly. And so that's why I don't like to do a lot of property, plant, equipment in this game. I usually like to try to keep a decent balance between current assets and basically property, plant, equipment. I like to also keep the current assets for potential opportunities that come up in the market. Like, for example, if I think my stock is cheap, I'll use my cash and equivalents towards buying back stock at the lower level, and then eventually I might be able to grow in the future, and then I'll be able to reissue shares in the game. So I find that pretty interesting. And you can see their current liabilities. Right now they have a lot of accounts payable. So right now they're not too liquid. So like this is their total account. This is their total current liabilities, and right here is their total current assets. So if you're doing the working capital ratio, which is just simply basically your total assets divided by your total liabilities in the short term, at least, this is a very, very important ratio. So we can see right here that we basically right now they have 729,062 in cash, basically in current liabilities. So the majority of it is in inventories, which I don't like. So if you're doing a quick ratio analysis, this stock would not be very liquid. But based on the current assets, I think they're semi-liquid. So you can look over here, 1167503. So right now, and you times that by 100. Oh, no, I meant to. Oh, my bad. So you can see right now they have 0.62. I was supposed to keep that. That was a little bit of an error. My bad. So you can see here it's 0.62. So basically, they have 62 cents for every dollar is kept in basically kept in current assets. So generally, you want this to be at least 1, ideally 2, because if you think about it, if the company is not able to meet their current liabilities, they might have to borrow money or anything. So that could potentially be a problem. But the good news is this company might be able to make a bit of profits, and then that'll go into their cash, and then they might be able to get this to a 1, and then that'll be ideal. But in this game, I usually like to keep a liquid position. So this shows you guys a real life importance of how important the quick ratio is. And so I'll cover in more complex accounting stuff maybe later on. Like later on this series, I'm thinking what I'm going to do is if I start making a lot of money, I might be buying up some property, plant, equipment from other companies, and I'll be able to manipulate those assets. But the problem is I might have to pay a high price for it. So I might have something called goodwill because I'm paying a lot more for the assets than they're actually worth. And so over time, it's going to be written off over time, or at least the depreciation. Like depreciation will come. Depreciation is probably one of the most complicated subjects when it comes to investing. So you can see depreciation is basically the life of an asset. So if you're out there buying property, plant, equipment, you have to be based on depreciation too, because over time your assets are going to depreciate in value, and so basically that's also why I don't like to keep a lot of property, plant, equipment. But every so often when I see a good opportunity to buy up some equipment, I'll go ahead and do it. Okay, so like that's going to end it up for the theory and everything. So I'm hoping that you guys enjoyed that. Okay, so now that's out of the way, we can basically now choose the industry that we want to choose. It's going to be a roulette wheel. So I did a previous take and I got engineering construction, but I didn't like the way I explained things, so I'm not going to do that. And so now we're just gonna hit the wheel again. Let's see what kind of industry we end up getting for the roulette wheel. We get Retail-Apparel. Oh god, this one's gonna be hard. This one's gonna be pretty difficult. So right now, we got Retail-Apparel, which is considered a cyclical industry, but there are some defensive aspects about it. Because if you think about it, airlines are one of the worst industries to invest in during a recession. Because if you look at, for example, Air Canada stock. If you look at Air Canada stock, for example, and if you look at like the last year, you can see basically during 2020, they were not doing so hot. But basically the last 5 years, you can see this is 2020. I invested in Air Canada around 2018, around $20-something a share. And then I sold most of mine at $29. So I'm a little bit bummed out that I missed the run up in price in real life. Like I missed a potential return of 84% potentially, or maybe at best 60 to 80%. And so I was a little bit bummed out with that, but I was pretty glad that I sold out of the airline industry because the airline industry is very, very cyclical. And a good example of doing this is to like look at a stock chart and see how volatile the stock is in nature with the economy. So what I usually like to do is I like to look at recessions. So right here during 2020, January of 2020, that was a bit of a optimistic time of period of the year, but then things started getting bad during March. So look over here at March, the stock fell from basically from the start of the year until March of let's just do February. It went down 32%, so that's reasonable. But then it fell like 75% because of the coronavirus pandemic, because people thought airlines were basically going to go bankrupt because of the lack of travel. And they have definitely gotten hurt, but they're actually been recovering lately because of the vaccines. So you can see that you have a 102% return if you would have bought at the lows. So that's a lot better than another example would be a more defensive stock, a very, very defensive stock, like the complete opposite. So an example would be Florida stock. If you look at like the last 5 years, this company is still kind of volatile, but it's a little bit less volatile. You can see right here, it was $58 in 2020 of February. I remember that. And then during March, I went down 20%. So that's not bad. 20% drop, that still hurts. But if you look at the drop on Air Canada, and I'm also not just picking out a random stock on my hat. You can look at any other airline, and airlines typically do really bad during recessions or viruses for that fact. So you can look right here. You lost 75% of your money. So basically, $100 turned into basically $25. $100 investment turned into $25. Whereas with this, you only lost 20%. So 100 times 0.2. You basically... Oh, no, that's not right. My bad. 100 times 0.2. You lost $20 on Fortis. So you would have had $80 left in the account if you would have invested $100. But if you would have invested basically $100 into your good old buddy Air Canada, you would have had basically $25 left, or a $75 drop in value. So that's a little bit scary. So I'm going to be a little bit defensive. And the apparel industry would be a good example of an apparel industry would be American Eagle. So American Eagle stock would be a good example of the apparel industry. They're actually one of my favorite apparel industries that I want to invest in. I was actually low-key thinking about buying this in 2020 at around $20 or like $18 a share. And I would have made a decent amount of return. But you can see basically over the last 5 years, they didn't do that bad. Actually in 2020, they actually did pretty well. That's actually kind of weird, but 2020... Where's March? Yeah, so basically, American Eagle wasn't affected much by the coronavirus, at least. So I'm guessing everyone needs their clothing, and etc. So that's pretty helpful. So with that out of the way, we can go ahead and get started with the thing. So we're going to do Retail-Apparel. So now we're going to get started with the game. Sorry for taking forever to actually be able and have Sorry for taking a while for getting into the gameplay. I just wanted to go over a bit of topics, etc. And yeah, so now we're gonna go ahead and get started with the game. So now we go over the financing tab, and then you can see this thing called Start New Corporation. So we can go, or maybe I can find a cheap stock to buy in the apparel industry. So we can look for basically search one industry, Retail-Apparel. And we can see we can buy 3 stocks, and none of them are under $1 billion, so we can't theoretically do a buyout. So we're gonna have to start our own company. So we're gonna go over here, Retail-Apparel. So I got a pretty bad industry to start off with, but I'm gonna, and like I said, the working capital is very, very important. So right here we have cash, which are basically your most liquid deposit. Like, it's very, very liquid, so you can basically do whatever you want with cash in this example. And then we have short-term T-bills, which are basically short-term investments where you can loan the government money and they'll pay us a pretty good interest rate. And then we also have working capital, which is your AR, which is your accounts receivable and your inventory. So this is a little bit less liquid. So it goes from most liquid to least liquid, or at least some of these accounts are more liquid than others. Like in the most liquid, it'll be cash, T-bills, stocks, options, I guess. And then I think working capital would actually be a bit more liquid than stocks and options. So it goes this from most liquid, stocks, options, and then business assets are your least liquid of all of them. So at the moment we have $500 million in business assets and $252 million in our short-term T-bills. So short-term T-bills are going to be like my best friend because they're going to be like our risk-free rate of return. So if I cannot find any good projects to buy, we're just going to start stocking up on T-bills and making a decent return. And then we have some liabilities and equity. So right here we have long-term bonds issued. Sadly, I have to wait maybe 2-3 years in order to issue bonds in this series. So you might be asking, why would I issue a bond versus a bank loan? So a bank loan, the benefits of a bank loan is its variable rate. So if interest rates go down, your payments go down. So potentially in lower rate environments, I could make a lot of profit if I have a lot of bank loans, because I might be able to take advantage of operating leverage. So basically I'll be borrowing money at a cheap rate, making a higher percent return on property, plant, and equipment, for example. And I'll be able to pay off that bank loan over time. But if rates go up, and they're most likely to go up in this game, my profits might be squeezed in this example. And we have long-term debt, which is basically a fixed rate expense. So in this case, I might have like a bond of a coupon of 7%. It means I'm paying investors 7% a year. And so I have to find a way to find projects out there that are making me at least 7% in order for that investment to make sense. So we can see right here we're at $18 a share. No, that's how much our book value is, how much our company is worth. So we can see right now we have equity. If you basically do a simple assets minus your liabilities, so your total assets is 900. Subtract that by your liabilities, which I have 0, so I'm at 900 in equity. 900 in equity, divide that by 50 million shares, we get $18 a share. So that's our book value. So the equity is basically what we have in the company. I can cash that out anytime. So I can hypothetically do that by doing a stock issuance. So I can go out here, and then I can go to financing, and then I can go ahead and issue private stock or public stock. So that's what I'm going to do with the equity once we do grow up our company. But right now, my main objective is going to be my income statement. But we're going to go into that in a little bit later. So we can see our earnings. At the moment, we have no earnings because we just started up the company. And then we can see that we're AA. So that's our credit rating. So what the credit rating is basically a very, very important thing because it basically tells how good I am at having the ability to pay back debt or stability. So right now I'm a very, very stable company. I'm not very, very, very stable because I don't have a lot of earnings and a track record of making earnings. So at the moment I'm a AA, which is still pretty great. And so at the moment I might take out a bit of leverage. I'm only going to borrow probably $250 million. So if we look over here, I can borrow $1.98 billion. That's kind of crazy. So if we do basically 250 is usually the amount I usually borrow whenever it comes to this game. So if we do 250 and then divide that by 1980, we can see that we'll be borrowing 12% of our lines of credit. So that way, if I'm not doing that well financially, I'm still able to offset all those potential losses or borrow more money. So I'm okay with that. And then we can see right here that we have dividends per share and sales and growth. And then you can see a little bit of extra details, but I don't really look at this that often. And so now we're going to go ahead and start with the game. And we can see our earnings. So here's a forecast from analyst expectations. So we're expected to make a negative $1.11 a share. And keep in mind we have 50 million shares outstanding. So 1.11 negative. Oh. 1.11. Oh, my bad. I'm just going to do 1.11 times 50 million shares. So we're expected to lose $55 million this quarter. So it makes sense because I first started up I made up the business. So right now we're not going to be profitable in the short term just because we just started. So I'm going to wait a few quarters and then hopefully we can start making some profits and then I'll be able to start growing my business. Right now Kohl's is the dominant player and our management is reasonably competent. So out of all this, the most important thing to look at is of course the profits that you're expected to make from analyst. And these are what you're expected to do. So if you make $1.11, Wall Street would be like, oh, that's expected. But if I theoretically make a profit and they're like, hey, you're expected to lose money, then my shares are actually going to do much better and my company's going to do a lot better. So like generally I want to start making profits as soon as possible, or at least in like the next year, hopefully. And then right here, the reasonably competent. So right here, you can see that my management is reasonably competent. So the best is very capable. The one below that is I think the one below that is reasonably competent. And then there's very incompetent or grossly incompetent. So generally, you don't want incompetent management because incompetent management aren't going to pick great projects. And so generally, you want to have a great R&D expense. So that way, you're able to basically be able to pick out good projects and make some good income. So it depends on your so right here you can see like these capital returns. So right here, projected pre-tax on capital assets. So it depends how good your R&D is or how competent your management is. The more competent your management is, generally the higher rate of return you're making. But at the moment, I'm only making 30%, which is still pretty exceptional. But the demand for the industry is very low. So like not lots of people are buying clothes. So I'm hoping that eventually I'll be able to grow. Right now we have a 1.6% market share, which is interesting. So in order to grow in this game, I usually like to mimic what other people are doing because generally they know the industry a little bit better off than I do. So you can see right here that one of them is growing at 6% and they have R&D of 2. And then one of them has an R&D of 7. So and one of them has 9. So I'm thinking about doing 9 and 9. So 9% growth, 9% 9% of our money spent on marketing. So that gives us 18% of our revenue is being put towards operations, and then the other profits that we make potentially could be used towards building up our balance sheet, and then potentially finding some good deals right here. Because you look over here, we're Urban Outfitters. We could theoretically go out here and buy up some assets. So right here, like this is a pretty decent. Almost all these assets right here are great. So if I want to play aggressive, I would hypothetically go over here. For example, if I want to buy up some Kohl's property, plant, and equipment, I can go over here, and I can look at like the company and see how much property, plant, and equipment they have, how good the company is financially. But I don't really care about their financials. I mainly care about buying their properties. So we go over here to buy and sell, and then you go over here to buy corporate assets, or you can sell corporate assets to them. But I'm gonna buy. So you can see right here, you care about a new company. I don't really care. So Kohl's, for example, and let's just do an example that I buy $50 million worth of assets. So that still gives us a decent amount of cash. That way we have liquidity to go and avoid bankruptcy. So now we're going to simply buy up $50 million. And then you can see right here, Urban Outfitters Inc. will be acquiring the assets at a premium of 85% over the book value. So the book value is how much the inventory costed them, which means that 46%. That is basically 85 divided by that, 185 that's how much we're paying, $185 for the asset. And yeah, I think so at least. I'm not too familiar with Goodwill, so I apologize for this. But basically, if I buy this asset, over time I'll be able to depreciate it. So it's going to take a few years for me to actually turn this investment into properly planned equipment, because it's going to count as goodwill because we're overpaying for the asset of 85%. So some of it is going to be used for investment purposes. So like if we look over here, right now we have amortized goodwill of 23 million. So it's almost half of our money is in amortized goodwill, which I'm a little bit unfamiliar with. So I might research a little bit about that and give a bit of a description about that, because I'm a little bit unfamiliar with unamortized goodwill. So if there might be a description saying what it is, etc. And we have business assets and we have some liquidity now. But I want to borrow 250 million because it'll be a pretty cheap borrowing rate. So now we're at basically a credit rating of A. So we got downgraded from A to A. So now we're a little bit more credit risky, but it's not really that big of a deal. So right now we can look at our current assets. So we have 200 million in cash, $250 million in bank loans. So we can see right here, 200. So now we're going to do our current assets minus our current liabilities to make sure that I'm keeping a nice liquid position. So you can see right here, 200 plus 249.12. We have $449 million in cash and cash equivalents, which that be in our bank deposits and our T-bills. And then we also have a bank loan of 250 million. So right now we're at 449 million in current assets. And then we just divide that by our current liabilities of 250 million. I generally consider bank loans to be a bit short term, because generally I don't like the volatility in the interest rates. So ideally I want to pay off bank loans ASAP. Whereas with long-term bonds, I don't really care if interest rates go up or down. Well, I generally want them to go up whenever I issue a bond, because then I'm able to buy the bond for a discount. But if we look at our current assets, we can see basically I'm at 1.7 times. So I have a decent amount of liquidity. Basically, I have enough to basically pay. So if we subtract this by 1, we can see that I basically am still liquid. So we're quite a liquid company. So I'm pretty happy with everything going. So I'm probably going to operate for 1 year, and then I'm going to stop the episode, and then we're going to continue with this series later on. So right now, remember last time we set like we set our growth rate? So right now I'm hoping that I'm able to pick up some good assets and continue to grow up our company. So let's continue doing that. Sorry about the dogs in the background, by the way. So I'm gonna I'm gonna slow it down a little bit because we're at the almost the fastest speed. So I'm gonna do it on 80 speed, just because I feel like I don't want it to go by too fast. I want it to basically you guys comprehend what's going on. So right now we're playing the game. Interest rates are starting to go up, which has me a little bit afraid, because keep in mind I have a variable rate loan. So you can actually see the interest rate I'm borrowing at. So I'm borrowing at 8.25%. And so if you're making an investment in property, plant, equipment, etc., you can see right now I'm making 26%. So if you do some simple math, you do 26 subtracted by 8.25, I'm keeping 17%. So basically right now I could have a ton of leverage and do just fine. But once my projects start turning bad, that is when I get a little bit afraid. So that's why I'm trying to stay A grade right now, because I could theoretically be triple B and be just fine, but I don't want to start hitting the area where I'm going to BB, which is considered junk quality, and then C, which is very, very risky and very, very speculative, and then D, which is just the worst quality. So like this company is in default because they borrowed too much money. So we can look at them, for example, and see how much mistakes they made. So you can see right here they have $200 million in cash, so they're not very, very liquid. And you can see right here they have, okay, so like if I want to do the current, if I really want to do the quick ratio and just ignore working capital, so we're gonna do 203 plus 50.96 million. They have $253 million in cash and cash equivalents. and we divide that by their current liabilities, which I generally consider bank loans to be current in this game. They could be long-term, but also I generally want to pay those off ASAP, etc. So 6506. So right now, we can see that they have 0.03. So they're basically keeping 4 cents of every dollar is in cash, and they're basically borrowing $1, but 4 cents of that dollar is being put towards basically cash and cash equivalents. So this company is not very, very liquid. So they're not able to pay off that loan. And so they're more likely to go bankrupt, especially if they have negative earnings. But $4,500 is tied up in equipment. So I do not want to be this company right now, because if you look at them, they have a lot of debt, and they're almost all their money is tied up in equipment, which they have to sell for less than it's worth because they're in a lot of trouble. So we look over here, they're expected to make 72 cents a share, but they're a strong sell, but they got great management. But the one problem is they just borrowed too much money, so I don't want to be them in this series, so we're going to try to play it safe. So now we're in January, and so now we're just going to continue playing the game. So we have a very, very high borrowing rate right now, which is kind of making me a little bit afraid. But now interest rates are starting to kind of soften up. So like you might be asking, like, why did interest rates move in the first place? Well, the central bank usually controls it, that being the Bank of Canada. So whenever interest rates go up, that generally means that the economy is doing well, and the Bank of Canada wants to slow down spending, because if you have too much spending, you have something called inflation. And inflation is generally a very, very nasty business term, because it means that your cost of living is going up. And if it's like above 2%, it's generally a concern, because your cost of living is going up a lot. So we have that in real life with America. America's having a lot of inflation right now. And so generally, in order to combat that, the central bank will raise interest rates, stopping the spending, and also making more money off of people's savings accounts, etc. That way they're able to offset some of the inflation. So right now, we reported our earnings. We actually did worse than expected. We made a negative $1.16 a share, and I think we're expected to lose $1.11. So we lost $58 million, sadly. So this is our first quarterly report. And we can see right here, we realized $1.24 million of our unamortized goodwill. And so we're growing our company by 9% every quarter. 9%, I mean. And then we're also having a margin of 27%. So we're keeping basically, if you do a quick math, if for example, if my business makes $100 million in profit, how much will they, I don't know, $100 million in revenue, how much will they keep? Well, 0.278. So I'm basically, for every $100 I invest, I'm making $27.08, 80 cents back a year. So I'm making a 27% return on my investment. So that's why I'm not too concerned about paying back this loan at the moment. But if interest rates do keep going up, I'm going to go ahead and borrow more money. No, if interest rates continue to go up, I'm going to pay back the loan, because it's not going to make sense. We had to borrow $246 million, sadly. But that was because I forced myself to do that, because I wanted to keep some liquidity. So our business is doing alright. But like, still, we're unprofitable, sadly. We're expected to lose 38 cents a share. So we're almost near profitability territory. So I'm pretty happy with that. So we're just getting our customer base up. We're opening up our store, and people are starting to see what we're doing. And we're starting to get some loyal customers, and once we get loyal customers, we can have recurring revenue. Once we have recurring revenue, then we're able to basically continue making profits. So right now, we just started our business, so we're in the early days of our business, so it makes sense why I'm losing money right now. But right now, it probably makes more sense that I pay back my loan, and then just start keeping money in short-term T-bills, because basically, right now, interest rates are very, very high. So if you look over here in the interest rates tab, you can see over here that treasury bills are making me 7.35%, all my money. So that's pretty great. So hypothetically, if I were to pay back my loan, any dollars that I have in T-bills are gonna make me a 7% return, and this is guaranteed. This is known as the risk-free rate of return. Whereas if I'm out there buying up property, plant, and equipment, this number is a lot higher. It's at 23%, but it could move around. For example, Old Navy isn't doing that well. They have 5% returns on capital. So at the moment, it makes more sense for them to sell off their assets and potentially just keep that in T-bills, at least for now. Or at least stop growing, and then eventually having the ability to having the ability to grow. And instead of growing, I mean, instead of growing, you basically just invest in T-bills and T-bills only. But we're gonna continue growing up our company. And I apologize for this episode being long. I wanted to cover a few things, and I want to do every year. So right now we have until 2057 until our gameplay is over. So I want to probably do a year or two at a time, and it depends on how long the runtime is. So, because like this is probably gonna be the longest episode of them all, or at least one of them, because it's a introductory video where I'm going over some topics and stuff and applying it to real life. So it's May 2022. We're doing all right. Are we starting to make a profit? We're expecting... Oh! Yay! We're in profitability territory now. So we're making 87 cents a share. And we're reasonably competent still. And we're spending 9% of our sales on advertising. Oh, wait. What's this say about cash flow? The company is doing R&D. Generating positive cash flow. I love that. So cash flow is basically more important than profits. Because if you look at the cash flow statement of a company, it shows what kind of cash is coming in from its operations, minus its investments, and then whatever is after that is considered free cash flow. And so free cash flow is very, very helpful for a business because they're able to basically do whatever they want with that free cash flow. They can basically continue to grow up their business, or they can invest in more property, plant, equipment. They could buy out a company with their free cash flow, potentially. So right now I'm aiming for free cash flow. That's my main objective. That's why I'm not buying up too much property, plant, equipment, because I'm not playing it aggressive. If I was playing it very, very aggressive, my some property, plant, equipment might not be good. Some of it might be great. But I want to play it conservative. So good news is, interest rates have just tanked. So that means that I'm pretty sure that the government might have changed their policy. So right now, you can see that they're easing. So right now, easing interest rates mean that credit is becoming cheaper. So I don't have to pay back my loan. So right now, T-bills are making me 4% instead of 7%. So that's just because interest rates are falling. And the government's like, oh, we want to stimulate the economy. So like they're actually going to try to make GDP go up a lot. So they're stimulating the economy by lowering interest rates. So it makes it cheaper for me to borrow money. And when it's cheaper for me to borrow money, I can buy a property, plant, and equipment with that cheap money and be able to continue to grow up my business. So right here, this is our second quarterly report. We made a profit. So we made 83 cents a share. And we made $41 million is added to our cash balance. So that's pretty exceptional. So I don't know what I'm going to do with that $41 million. I could theoretically pay a dividend right now, but I want to focus on growth of my company, and then later on I want to pay a dividend. Especially I want to pay a dividend when interest rates are high, because if a dividend is being paid to myself, a dividend is basically a company's profits being paid to you. And so if I receive a dividend, that dividend is going to be put into cash. The one problem is that I get double taxed on it. So if I share my profits with myself, I'll have to pay a 26% tax rate, which is kind of crazy. So if I give $100, I'll have to pay back. If I give $100, I have to pay $26 in tax in this game. So dividends, I usually don't like to issue them in the game. But if I see a better investment alternative like bonds, I'll do them. And sadly with this game, you cannot buy bonds when you're just a business. So I love the ability to buy a bond in this business account, but you can't. You can only do T-bills, sadly. So bonds are a lot better because they're fixed income. So if I receive a dividend, I will hypothetically be putting that dividend towards bonds, because right now I can lock in my money until what time period? So we can see right here, trade government bonds. I can lock my money in a government bond into 2042 and make a, let's see how much yield it is. Let's just say 1. Oh, it doesn't tell us the yield, sadly. But the yield will be about 7%. So it makes 7% of our money every year. So that's why I love financials in this game, because you make a stated percent of interest. Whereas with property, plant, equipment, or whatever, you don't know what the return could be potentially, because it depends on how good your management is. So interest rates are continuing to fall. And the benefit about buying a bond too, if I would have locked my money in for 7.5%, and let's just say interest rates go down to 5, well, that makes my bond actually worth more, because I'm receiving 7.5%, while other people are receiving 5. So if I'm out there and trying to sell my bond, I could potentially sell the bond for more than it's actually worth, because I'm receiving more income from it. So I'm able to sell it for a premium. So that's why I love bonds. You can make a good amount of income, and you can also make capital gains. So they're like my favorite type of investment in this game. I actually honestly love them more than stocks in this game. It depends on the interest rates though. If interest rates are low, I generally love stocks. If interest rates are high, I generally like bonds. You should do that in real life too. If you're out there and you're doing a stock portfolio, for example, and if a dividend stock is making you a 5% yield, but you see out there that there's a bond that's paying you a 5% coupon. Basically, the 5% coupon would be better because it's a bond. Bonds are generally safer than stocks because they're debt. So companies have to pay it back. They have an obligation to pay it back. Whereas with dividends can be cut at any time because the board of directors could just say, hey, we're unprofitable. We have to cut our dividend because it comes out of profits. Whereas with a bond, it comes out of EBIT. So it'll be earnings before interest and taxes. But dividends come out of profits of the company. So it's generally your bonds are a lot safer. Hence why I love bonds in this series. But we can't really buy much, sadly. So right now I'd love to be a participant in the bond market, but too bad. We're gonna have to be patient with this series. As of right now, it's June. So I'm gonna go ahead and speed it up until we have our next quarterly report. So I apologize if it's too fast. So right now interest rates are falling. It's pretty great. Making our credit line cheaper. So we're slowly paying back our bank loan. And as of right now, we're making 69 cents a share. So that's pretty great. But we're probably not doing all that well because we're not growing all that much. We're not following what other people are doing. Right now, we're at 19% returns. Pretty great, though. And we have 1.5% of market share. And we actually beat in A&F at the moment. So we're actually a pretty big player in the apparel industry. And I think one of the benefits, not to sound like a bit of a meanie or a bad person, but generally, if these companies go bankrupt, it's going to make the industry a lot more attractive because there's less participants in the industry. So if all these companies, if a lot of these bad credit rating companies go bankrupt, then basically there would be more entrants in the market because the industry is going to be a lot better. So right now, I'm actually a pretty happy person right now that I got apparel. Because right now we're going through a bit of a weird time where companies are actually going bankrupt. And so potentially I can take away their customers and I can continue to grow. And it's just a natural form of business because when it comes to it, if we do what we do, I think it's called crony capitalism, where basically you continue to bail out companies and always forgive them. And so that's a big problem when it comes to everything because the government's pumping up themselves with debt. And they should just let the free market decide, and they should let companies fail. Or at least that's some people's arguments, is that some companies should fail, and then there'll be new entrants in the market that will make up that demand. And potentially you could save a lot of tax dollars if you let some companies fail. But the one problem about that is there are some companies that are too big to fail, and if they fail, the entire economy basically goes down. For example, in 2008, 2009, Lehman Brothers was a very big fund back then. They went bankrupt, and that's probably one of the reasons why the 2008-2009 recession was so bad. I'll probably show a video of like a summary saying like how bad the 2008-2009 recession was. But basically, yeah. So some companies, they have to go bad. So that's at least my personal opinion when it comes to politics. Some companies should go bankrupt. Because if you think about it, it's just a lot cheaper if they were to go bankrupt than trying to bail them out. Because you're just basically bailing out incompetent management. That's at least my personal opinion about the whole thing. We're in July. I feel like we're going to do pretty well. Because I'm thinking it's summertime, I'm guessing. People probably want more clothes. And the economy is doing pretty well. So let's go ahead and look at an industry report and see how well the industry is doing. So right now the 6-month profit is acceptable for the outlook for the industry. However, profit margins are expected to slip from current levels. So over the long term, profit margins are expected to drop because I'm guessing more entrants are going to come in, or at least there'll be more people that want to, like more supply of clothes or whatever. So that would mess up things. And the industry's growing at 3% a year. I'm growing at 9% a year, so I'm growing like 3 times faster than the industry. Some people are growing really, really fast though, which has got me scared. We can see right now we have high energy prices, reasonable interest rates, and very low tax rates. So I love low tax rates. And right now oil is kind of high. So we're expected to lose a little bit of profits. So hence, that's why I'm playing so conservative. Because every once in a while, there'll be some bad times in the industry. And I'll be able to manipulate those bad times by buying up assets. So theoretically, right now, it's a good time to go out there and look for equipment to buy. Because I have a little bit of extra cash. So right now, we can look at our liquidity real quick. As of right now, we have 161 million and 21 in cash. Plus our 339 in T-bills. Oh, my bad. I accidentally mistyped. So we have 501 million in cash, and then we divide that by 242.56, I guess. So right now we're at 2 times things. So I want to get that to 1. So in order to get that to 1, we'll simply just do 339. In order to get that to 1, I think 339 plus. So we have 500. So I'm probably just gonna divide that by 2. So we have basically, I'm gonna go out there and buy up some property, plant, and equipment for 250 million, because right now the industry isn't doing all that hot, and still we're gonna be having a liquid position of 1-to-1, and plus we'll have our profits to be able to add to our liquidity. So right now I'm gonna go out there and look for some property to buy. So what's a good opportunity? I'm looking for very, very high returns, and so right here, ITX, 20% returns on their capital assets. And they're a D, so I'm guessing they're quite desperate for selling their assets. So I'm gonna go ahead and be the buyer of those assets. So we're gonna hit buy corporate, no, and we're gonna buy 250 million. So we're gonna buy up some property, plant, and equipment. Right here, Urban Outfitters will acquire the assets at a premium of 77% over book value, which means that 44%. So we're basically gonna be paying 77% over book value. I'm okay with that. So that's considered goodwill. So at the moment we have 233 in cash, 130 million in amortized goodwill, and 776 million in business assets. And I think our AR went up a little bit. So right now, based on our current ratio, we are liquid, but based on our quick ratio, we are not liquid. So if we were to do the quick ratio, for example, in this game, I usually like to do the quick ratio. So if we look over here at 233 in short-term T-bills, divide by 242.56, I'm at 0.96. So I basically have 96 cents for every dollar in debt. So I'm quite liquid right now when it comes to my current assets and current liabilities. But like this is actually the quick ratio that I have. If you want to include like basically inventory, which is your current, your current ratio, I'm doing that right now. So it'll be 233.33. So right now we're at 325 million. Divide that by 242. Because eventually the accounts receivable will be collected. Because those are just late invoices that we gave to people or whatever. And then inventory, eventually that inventory is going to be sold. So right now we're at 1.33 1.34 times on the basically on our current ratio. So our current ratio is much better than our quick ratio. That makes sense because we're including inventory. But if you're a little bit more picky, I'm not super duper liquid right now, but I'm quite liquid. So we're doing all right. And plus, the good thing is I have a line of credit that I can draw on. So like potentially this is more liquidity that I could potentially take on. Is I could borrow a bit more money, and then I'm able to have the cash I need to operate the business. But I'm doing all right now. It's August. So our business is doing pretty well. So we can see right here, we are now at 12% return. So we went from 19 to 12. So like the industry report said, profits have fallen. So right now, it's a potential great opportunity to look at some companies' assets to buy, or mainly just keep cash right now and try to wait out the storm. Because right now, industry, like the profits aren't so good. So my objective right now is going to be trying to build up my balance sheet to to deal with this storm, basically. 30 million in earnings. We fell short of 63 cents a share. I don't really care too much. As long as we're growing, we made 62 cents. So that 30 million is going to be used towards cash because I want to build up my balance sheet. I don't want to do any more acquisitions for assets. I just want to start working on my cash and cash equivalents. That way I'm able to have a better quick ratio. And then whenever I have a quick ratio of over 2, I'm going to go ahead and start buying up some assets because I want to make a high return on my assets. So we're going to continue growing up our business. Hopefully we do well in the long term. We're in September, so the year is almost over. And when the year is over, I'm going to end this episode. And I'm hoping that you guys enjoyed the edited video, because I feel like I'm going to try editing this video, and I feel like it's going to be a good thing to do. Yep, so I'm going to edit this video, make sure I have some nice text, I have some nice images of things, and I have some sources, etc. So our company is doing alright. We're at $1.3 billion market cap. We're doing alright. And the problem right now is my personal account, I'm actually making negative cash flow. So right now, my annual dividend income, I'm not making much off of my, so am I the Urban Outfitters CEO? I am now, I guess. So now I should be receiving a salary. So right now I'm receiving a projected salary of $1.68. Minus our, so that's our cash flow. We have our pre-tax cash flow minus our projected income tax. So now we have $1 of annual living expenses. That's aka 1 million. And so now we're expected to make have annual cash flow of 0.24. So almost $250,000 we're making a year off of our Urban Outfitters stock. Because I'm an employee, I'm the CEO, I'm running this business. So I want to make a decent return. So as we grow the business, my salary is going to increase. And as my salary increases, I'm able to go ahead and buy up some government bonds. And then I can potentially sell those government bonds for more. And then I can do a simple capital contribution into my company. And I'm able to grow my business quite high in the future. So right now I'm quite optimistic over my portfolio, basically. We're doing all right. December, so we should have a great quarter for December. 55 cents. Oh, we have here's our most recent quarterly report. My bad, I accidentally closed it. 17 million. So profits are falling, sadly. But like I said, we barely have any leverage. We have a lot of liquidity. So our business is doing perfectly fine. I'm able to weather off this storm. And I could theoretically run at a loss for quite a bit of time. And I'm okay with running at a loss for quite a bit of time. Because I expect to lose money every now and again. Whereas other companies that have a lot of debt, they're forced to make money. Or if they don't, they're going to have to sell their debts. So right now we're doing all right. And there is some liquid companies. Like all these companies over here are quite liquid, but some of these are going to go bankrupt. And when they do go bankrupt, I'll be able to make higher returns on capital potentially. Or at least they're going to sell some of their assets to me for a much higher point. Or at least I'm going to make a decent amount off their assets if they sell it to me. So right now we can see our stock chart. We're kind of going along slowly. This is definitely a lot slower paced than banking. Because banking, I'm usually a giant bond trader. I usually like to time the bond market in this game. And with patterns, yeah, you can tell that with patterns. Like if you look at the pattern, you can see right here, interest rates went up a lot. They went up a lot. And I thought like the interest rates were quite high here. I would have bought a ton of bonds here, and then interest rates fell. And then I would have thought that bonds would have been a good sell here. I would have sold the bonds for a capital gain. And then I would have kept the cash. And then I would have thought right here, a decent buy for bonds. And then a decent sell. And then potentially if they continue to rise, a decent buy. So like that's what I do when it comes to this game. Most of the time I love financials and insurance. But I feel like if you want a slower pace environment, of course you want to do the cyclicals. Which are... You're basically the only two that don't really rely too much on basically the return on capital expenditures is banking, because you can see it says NA, so you don't know how well the industry is going to do for banking because it's based, all they're doing is doing loans, but like these things are basically how much money the company is going to do economically. So these are known as economical areas, and then the other one's insurance where it has NA. And I think the third one is ETFs. So you can see ETFs have NA too. So like these are not that reliant on how the economy, well they are still kind of reliant on how the economy does, but you're not going to have like incompetent management being a fear. So I barely ever touch the economical areas of this game, but I feel like if you want a slower paced environment, then it's good. Oh shit, my bad, we're in February. So that's my bad. So now I'm going to go ahead and stop the episode. So we ended the year with quite a bit of money. So right now we grew our equity from about 900 million to 1.35 billion. So we're doing all right. So I'm hoping that we're able to continue making profits, and then I'll be able to build up my balance sheet and then continue making great acquisitions and increasing shareholder value. So eventually I might want to IPO where I issue stock to the public. And eventually I want to issue a bond. And then eventually I want to do an interest rate swap. So if I think interest rates are very, very low, I'll do an interest rate swap. But I'll cover that when I actually get there. So at the moment, we're doing all right. I hope you guys enjoyed this video. I covered a few important things about real life. And also I'm playing a simulation game. And giving my take on how I would personally run a company. And so like this is a great example of how I would run the company. So I hope you guys enjoy this new video, this new challenge idea. So I feel like if you guys got this game, maybe give the roulette wheel a try. Because I feel like it's a pretty interesting thing. Because you can theoretically get any industry and play around with it. So like, for example, I could theoretically do entertainment and broadcasting or ETFs. I usually skip ETFs because you need a lot of money to buy them. But you can continue doing this wheel and basically finding up some decent industries. So we can do tire and rubber, for example. So I might continue doing this and doing the roulette wheel for a little bit of fun. Anyways, I hope you guys enjoyed the video, and I'll talk to you guys later. Bye-bye.